Yeah, it's good stuff, right? So we go on to the next session. We will take a look at what's needed to be done for the financially excluded. It's such an important issue, and we have been talking about it in some depth here at the festival. Greta Bull is Chief Executive Officer of Consultative Group to Assist the Poor, and she will share with us her thoughts on the last mile in the inclusion race. Moderating the fireside discussion will be Toyin Sanni, who is Group Chief Executive Officer of Emerging Africa Capital Group. So let's join Toyin and Greta for more discussion around financial inclusion.
Thank you very much. It's an honor and a pleasure to moderate this session with no less a person than Greta Bull, who is an authority on this topic and has worked with a lot of excluded groups from across the world. When we're speaking about excluded, financially excluded people, we're talking about the poor, we're talking about people in remote areas, we're talking about people who frequently are living from hand to mouth, a great proportion of whom are in sub-Saharan Africa and also in Asia, and of course in other parts of the world. Now, getting across micropension and microinsurance products to such customers is not just a matter of difficulty of access, but the challenge also includes how to explain and justify such investments to people who are barely living from hand to mouth and many times can only think about their immediate needs. Greta Bull, as Chief Executive Officer of CGAP and also as a director of the World Bank, has worked with these excluded groups and has a great insight into this. Greta, it's so lovely to moderate this panel with you. I am impressed by your track record and what you have accomplished in over 18 years in development finance, primarily focused on small and medium enterprise finance. And I'm looking forward to hearing from you. And I will just welcome you and ask if you have one or two introductory words before I go into the first question.
Thank you, Toyin, and good morning, good afternoon for you, good evening for colleagues in Singapore. It's a real pleasure to be here. So we're talking about micropensions, microinsurance, and microsavings today, and that's a topic that is of huge importance, and I think it's become more important during the pandemic. So really looking forward to having this exchange with you.
Fantastic, thank you. So Greta, micropensions, microinsurance, microsavings were products that were already challenging and difficult to deliver even before the COVID-19. How has the pandemic changed the way we look at the importance of reaching these poor clients with these products? Thank you.
Yeah, thanks, Toyin. This is a topic of huge importance in terms of providing safety nets for the poor in times of stress, which this most certainly is. And it's a topic that's been overlooked by the financial inclusion community for a long time because there are quicker wins in the payments and credit areas. So as a collective, I think, we've made a lot of progress on building the rails to deliver these services, but we really need to think about solutions that work for poor people in the savings and insurance space. And before I get into this more, I'd just like to thank some colleagues. I crowdsourced some ideas on these comments from colleagues at Pinbox, Oxford Policy Management, and Microinsure, who've been at this for a really long time and were able to give me some really good ideas for these remarks. So, the pandemic's really exposed the vulnerability of self-employed informal workers. Most ran out of savings within a few days of the lockdown, which added a lot of economic and social strain in addition to what was an emerging health crisis. And if you think about it, if most informal sector workers can't survive for 20 days without an income, what are they going to do in 20 or 30 years when they can no longer work? And so there is a need to think both short-term and long-term in terms of these kinds of safety nets. And the fact of the matter is the impact evidence for both savings and insurance products is really clear. They play an important role in building resilience for poor people and helping them manage through shocks. Now, can you get through with your savings a pandemic shock of this magnitude? Probably not. That's going to require government interventions. But people need to have the reserves to get through to the point where government support can get to them. And so to me, the first line of defense is really savings. if you can't really insure against every risk. Nobody could have insured against the pandemic, right? And most people will only probably insure valuable assets or against catastrophic risk of things like crop failure. So what we really need to do is focus in the short term on building savings products that work for poor people. And we know that there's a demand for these products. I mean, poor people vote every day with their feet and their money and their time. But because of high transactions costs, difficulty of access, the appropriateness of products, and the need to not put all their eggs in one basket, many poor people still persist in using either non-financial savings like chicken, cow, land, some sort of asset, or in using informal mechanisms like borrowing, lending small sums with relatives, friends, neighbors, informal savings mechanisms. And in fact, that we know that people are willing to pay for that, right? In West Africa, people pay susu collectors to come gather savings so that they can't spend them, even though they know there's a risk that that collector may not return the money when it's needed. So the demand's there. And in some cases, poor people are even willing to pay for it. But those low value savings accounts are really few and far between in formal financial institutions. Insurance and pensions are longer term prospects that are kind of more abstract for those who are living on a day-to-day sort of basis on small amounts of money. But they have a really important role to play in the event of disasters as well. So I'm not sure we could have insured against pandemic risk at the level of the individual household, but if a crop fails, which in this year of plagues in East Africa was entirely possible, you can insure against that. And of course, you know, what it highlights is everybody needs to have access to some kind of health insurance in times like this, because people are needing medical attention because of the pandemic. Pensions are an even tougher nut to crack, not only because they're more abstract, but they involve a longer time horizon. So it's hard to make that work for somebody with minimal resources, but they're so important to building long-term resilience. And in dire circumstances, there's savings that can be tapped into in times of trouble. So just to give you a sense of the scale of the pensions problem, according to colleagues at Pinbox, roughly 1.2 billion, mostly young, economically active, and financially included non-salaried workers across Asia, Africa, and Latin America aren't eligible for any sort of formal pension and social protection benefits. And they could face up to 20, 30 years of extreme poverty once they're too old to work. And the folks at Pinbox estimate that by 2050, 8 in every 10 of the 2 billion elderly that we expect to see in the world will be living in developing economies, which will place a huge strain on public finances. So we really need to look at options that help people save for old age. So a 25-year-old today, by saving $1 a day, can enjoy an inflation index monthly pension of about $400 a month for 20 years, starting at the age of 80. So, you know, if even 10% of those excluded formal workers can start saving $1 a day for old age, they can generate $1 trillion in new long-term aggregate savings within the next 5 years. So there's a huge opportunity here, but there are lots of hurdles to get past, not least with the people you're trying to reach. Why save for that $400 a month in 35 years if you need the cash now? And why would you believe that a provider will still be around when you're ready to retire? So there are pretty big hurdles to overcome on the customer side as well as on the business model side of things.
Wow, thank you so much for touching on some critical aspects of this challenge, for emphasizing why it all begins with micro savings, and bringing up the experience of poor savers in West Africa and Nigeria, my country in particular, who are actually willing to pay for the opportunity to save. So not only are they not earning interest on these savings, they're actually paying the daily collection agents that come. And that gives an idea of the amount of demand that there is actually for micro saving services. And so if this can be properly structured, it becomes an opportunity, you know, for providers. And also for talking about the issue of the elderly and the fact that the pressures of COVID-19 have actually impacted on, you know, security, the safety, and long-term security of people. Now, I want to ask, how do you see the business models changing? How are they changing to overcome the challenges of delivering these products? Can digital technology play a role and make these products commercially viable?
Yeah, you know, I think digital can help, and we're starting to see efforts to leverage digital to make these kinds of products available. But I have to say, it's been more of an uphill battle in the savings, insurance, and pension space than it has in the credit and payment space. But we have fintechs emerging like Microinsurance, like Toyin in West Africa, Pula that operates across the continent. We've got Kaleidofin in India and Pinbox. They're all focused on savings products, investment products for low-income households. And the traditional reason that formal savings have not been available to the poor is that it's expensive for traditional providers to support individual accounts when people have relatively small sums to save. That's what banks will always tell you when they can't provide those services to people. And yet, we know that large sums can be amassed in store of value accounts because mobile money providers do this routinely. So we don't know the exact figures in mobile money float accounts, but we do know that they hold large amounts of money, and the interest on those funds accrues to different parties. So, for example, in Kenya, it's a charity associated with M-Pesa. That was the deal they did with the regulator when they started M-Pesa. The bank is the default. In many cases, they keep the interest on the float. And in some markets like Ghana and Tanzania, providers are actually required to pay interest. Well, they don't call it interest, but they pay something like interest on the funds that are held in mobile money accounts. So why haven't we been able to make those small savings, small value savings accounts work commercially for people? My suspicion is that most traditional providers, banks and MFIs in particular, don't have the interest or the ability to manage those small value accounts in a profitable manner. Mobile money providers can do this. They've proven that they can do it, but there's actually nothing in it for them to support more productive uses of those models. In many markets, actually, regulation doesn't permit it, but also it's not part of their core business model. So they don't really have much of an incentive to provide that service. And, in most cases, somebody else benefits from the float. So it strikes me that mobile money float accounts represent a bit of an underutilized resource in providing economic value. There are good reasons for this, but I think it is worth understanding the experience of Ghana and Tanzania where interest is paid out. And it shows that other products can be developed that profitably leverage savings of low-income households as a source of liquidity. Maybe it's not in the wallet, but in some sort of dedicated savings vehicle, which fintech partnerships are starting to offer. People do understand savings, and if they find ways, and they do find ways to save informally if formal options aren't available. And so I think people are going to start finding better value propositions for providing saving services to low-income households. But it's not as much of a slam dunk as digital credit has proven to be. It's not as obvious a business case. And pensions and insurance are harder. Partly that's from the customer side. As I said before, they're much more abstract products. And that makes it harder for people with scarce resources to think about, hiving off money to do that. So, we've seen though success in sort of using behavioral nudges and sort of bundling tricks in a lot of markets. So, for example, in the insurance space, what they've done is use things like freemium models, where a provider like an MNO is willing to underwrite a life insurance policy to enhance the loyalty value of that customer continuing to keep an account with that provider. Other options include bundled services. For example, just bundling crop insurance into the price of a bag of seeds, for example. But, in the insurance space, there are a few challenges, right? You've got distribution challenges, you've got data challenges, and you've got customer value challenges. And part of the problem on distribution is, you need a big footprint. You need to get to a lot of customers to make that product work. But a lot of the early innovators in this space, they created partnerships with mobile network operators because they've got the distribution. But very quickly and very easily, they were disintermediated because, the MNO could just do a deal with the insurance company. So why do I need that middleman in the middle of this whole thing? And so, the broker loses the business. The MNO then eventually loses interest if the service doesn't visibly reduce churn, and that leaves a distribution challenge for the provider, and people are out of insurance again. So, I think there are pieces that have to come together to make that work, and we haven't quite cracked that nut yet. Another challenge is the need for data in underwriting insurance, particularly in markets where data doesn't exist. I remember talking to somebody from Microinsurance years ago about the very first freemium life insurance product that was introduced in Ghana. And when they constructed that product, to build that product, they had to use data. For a Ghanaian man in the 2010s, they had to use data from South Africa, white South African males in the 1950s, which is just utterly ridiculous. The data just wasn't there, though. And that's also a challenge if you look at the indexed crop insurance area, especially where weather stations aren't present or they're not omnipresent or satellite data is not available. And then you get, countries like Rwanda that have a lot of different microclimates, which make it difficult to provide that kind of indexed insurance. So building up those data sets is expensive and takes time. And then, there's the customer value proposition as well. Most of us insure important assets against big risks, right? Houses, cars, health. Do you ever buy those insurance products for things that you buy online? Most people, I think, probably don't. But most poor people don't have those kinds of assets. Health insurance not readily available, and people don't have access to a lot of spare cash. So providers have to get creative and meet customers where they are. So bundled services is one answer that's worked. But another is getting creative about your products, right? So one of my favorite insurance stories comes from Lorenzo Chan, who's the CEO of Pioneer Life in the Philippines. And he spent a long time trying to help think through insurance products that might work for the low income segment. We always think about life, health, assets. He actually had a product before the pandemic that was insuring against being jilted at the altar. If somebody, their marriage didn't happen, then they could get money, they could go on a honeymoon on their own or take a friend along. It's kind of giving people, it's meeting supply and demand. And there was a lot of demand for it before the pandemic. And then, on the insurance thing, the myopia issue, I think, is particularly challenging here. If I don't have enough money today, why would I put it away in 40 years? And that abstraction is really hard for people who are living on $1 a day. So, I think there's a lot of challenges in that space, but there's a role for government, I think, where, most 25-year-olds in the markets that I work in, they wouldn't put money away for a pension, but because their employer matches it, then there's an incentive to put it away. And I think there is a role for government in terms of providing incentives for informal workers to put money away for later in life. And Rwanda has actually just opened a national level digital micropension program that does have those kinds of fiscal incentives in partnership with Pinbox. And they've already got 600,000 voluntary subscribers within the first 1.5 years. So it is possible, but it needs a little bit of a push, I think, from government. So the bottom line is there are good fintech providers out there trying to crack the business case for these kinds of products. But the road to profitability is inevitably going to be slower and more difficult than it's been for things like payments and digital credit. That said, I'm pretty optimistic that we'll find some technology-enabled solutions out there, but it's going to take the right partners, patience, and investment to make it a reality.
Wow, Greta, you've unpacked so many relevant issues. And the peculiar nature of the challenges in this space, the strong need for innovation, and the data gaps that need to be filled, and very importantly, the role of government. So I'm just going to ask you one more question now, and that is, do you think there's sufficient support, infrastructure support for the type of technology that we need to deploy to resolve this problem? And you have already spoken about the role of government, but how can we get this kind of support in place to make a difference? What ideas do you have?
I think there's a big role for government here, actually, Toyin. The infrastructure is not there. People still need distribution channels. They still need the ability to turn cash into digital and digital back into cash. And so, we don't have that kind of infrastructure in place in most markets. The margin for error is a lot smaller when you're when you're introducing this kind of product. So I think we need to really think about getting those infrastructure pieces out into rural areas in particular. Agents remain a really important interface between the analog cash and digital economies, and their density just drops off a cliff when you get beyond urban areas. So what are a few things governments can do? First of all, they have a really important role to play in building that basic infrastructure on which the digital economy depends. That means rural agents, payments rails, and basic accounts. And countries like India have done really well investing in parts of this, and it's paid off in the pandemic. We've been able to get social payments out to people, et cetera. So we're seeing all kinds of innovative providers coming in with these kinds of services for low-income households, but they need those basic rails, distribution, payments rails, things like that to make it work. Beyond that, as I said before, governments have an important role to play in helping incentivize the uptake of these services that are vital from an impact perspective, but it's hard to make stack up from a commercial perspective. So how? On savings, they could take a look at the regulations for float accounts and try to understand what the experience has been in places like Ghana and Tanzania, where providers do essentially pay interest on float balances. Maybe there's something we can do there, either to change consumer behavior towards holding money on the account or improving the business case for providers. They can use government-to-person payments or even person-to-government payments to help extend agent networks into rural areas. If somebody's got a predictable revenue stream, it makes it a lot easier for them to build a business case about putting those agents in rural areas. They can also use those social payments to get access to accounts for people, either in banks or mobile wallets. We've seen that as a mechanism that's been used a lot during the pandemic. They can also change restrictive requirements that limit who can be an agent and push for the interoperability of agents in rural areas. They can invest in good public data sets. Right? So we talked about data being a limiting factor, and particularly in the insurance space. And that really is the fuel for business models. And a lot of that comes from public sources. So investing in data on what's going on in the country is also really important. They can also provide incentives for long-term savings, just as the government of Rwanda is doing. So I think there's a really important role for government here. And frankly, the payoffs for them are really valuable too. They can't afford to provide these safety nets forever. And encouraging and incentivizing people to save for their own benefit is really the best safety net imaginable. And I think there is a really important role for government to play in stimulating that.
Thank you. Thank you so much, Greta, for identifying the challenges, but very importantly, for coming up with concrete ideas as to how these challenges can be surmounted through government providing infrastructure, incentives, and innovation on behalf of the players. Thank you so much, and I look forward to more opportunities on other fora to explore this more. Thank you. It's been an incredible pleasure speaking with you. And I thank everyone for participating in this session.
Thank you, Toyin. Hope to see you in Nigeria someday soon.
That will be awesome, simply awesome.
Toyin and Sanni there speaking to Greta Bull. A fantastic conversation, and we thank them both. And all of that about what's to be done about the financially excluded.